Alright students, welcome back, and today we're going to talk about how banks create money. Banks create money out of thin air. It's magic. It's magic. The reason that banks are able to create money is because we have what's called a fractional reserve banking system. And what this means is that when you put your money in a bank, banks are only required to hold on to a fraction of your deposits. And with the rest of that money, they can loan it out to other people. When the bank loans that money out to other people, they literally create money. Because if you were to go back to the bank and take your money back, let's say you put $100 in the bank last week, the bank decided to loan out $50 to me. Even though they gave me $50, if you go back to the bank to take your $100 back out, they have to give that to you too. So this new $50 that has been given to me is new money that did not exist before. Today we're going to talk about how that works. Before we can talk about how banks create money, first we have to talk about a bank balance sheet. So this is a bank balance sheet for a bank called Tay Bank. Thank you for banking with Tay. On a bank balance sheet, you're going to see two sides to this basically. You're going to have what are called assets and what are called liabilities. Assets are things that you own that can make you money in the future. They're things that you own that are worth money. Liabilities are things that you have to pay people back for. So for a bank, demand deposits, aka people's checking accounts, are going to be liabilities that this bank has to pay back to the owners of that money whenever they come asking for it. Let's say that right now we have $1,000 in demand deposits in Tay Bank. There's $1,000 sitting in Tay Bank. Okay, next. Loans. Let's say that right now Tay Bank has $500 in loans that have been given out. That's money that I have loaned out, and it comes from this $1,000. Loans have to come from these demand deposits. The money that the bank loans out has to be coming from someone's checking account. So I'm the owner of Tay Bank. There's $1,000 in people's checking accounts in Tay Bank right now. This $1,000 is going to go into my reserves. Tay Bank has $1,000 in reserves that I have to hold on to. So they're both an asset and a liability. They're a liability in the sense that I have to pay them back to whoever actually owns the money. They're an asset because I can now turn around and loan that money out to other people in order to make money off the interest that they would have to pay me back for borrowing from me. So the money in the reserves has to come from the demand deposits. That money in the reserves comes from demand deposits. Now there are two types of reserves. There are required reserves and there are excess reserves. The required reserve ratio is the percentage of money that a bank has to hold on to at any given time. This is the percentage of money that's in checking accounts and demand deposit accounts that the bank has to hold on to at any given time. The reserve requirement ratio is set by the Federal Reserve. They tell other banks how much you have to hold on to. And they do this in order to control the money supply, to control how much money there actually is available in the country or in the world at any given time. So right now I'm going to say that our required reserve ratio is 10%. So that means out of all the money in checking accounts, I as the owner of Tay Bank, or the bank in general, have to hold on to 10% of all money sitting in demand deposit accounts right now. So I'm required to hold on to $100. 10% of $1,000 is $100. So I have $1,000 in my reserves. Of that $1,000, $100 is required to be held on to at any given time. I have excess reserves of $900 because I have $900 more dollars in my reserves right now than I am required to hold by law. So, what can I do with that $900 in my excess reserves? Excess reserves can be turned into loans. I can now loan those out to individuals. So let's say now that I make a loan of $900, and in fact I'll just scratch it out. So that $900 is now zero because I'm loaning out $900. So this $900 in loans has to come from demand deposits, but it has to be something that is it has to be in my excess reserves. It has to be in excess of whatever I'm required to hold on to by law. Next, we're going to talk about the money multiplier. All right, children, now we're going to talk about the full way that banks create money. When they give out a loan, that's not the end of the money creation. Much like when we were talking about fiscal policy with the tax multiplier and the spending multiplier, there is a multiplier, a money multiplier for loans in money creation. The money multiplier is 1 divided by the reserve requirement ratio. Now, the way this works, again, earlier, there was $1,000 in Tay Bank in demand deposits. Let's say that Sarah came in and took out this loan for $900. She's going to either first, before she spends it, put that money into her own checking account so then she can actually go spend the money easily, or she's going to buy things in different places and those people will put the money back into their own checking accounts. Regardless of how it happens, this $900, most of it or all of it, is going to end up back in a checking account. So if it all ends up back in a checking account, and we have $900 here in a different checking account, and the bank still, because the Fed sets the reserve requirement ratio, the bank still, whatever bank it ends up in, has to hold on to 10%. So now that bank has to hold on to $90. They are allowed to loan out $810. Let's say Jeffrey comes in and takes out a loan for $810. He's going to put his money in the bank as well while he's writing out his checks to whatever, like the contractor that's going to be fixing something in his house. I don't know. He's got $810 in his checking account now. That bank, again, is subject to the reserve requirement ratio set by the Federal Reserve, so every bank has to follow it. That bank has to hold on to $81 out of that $810, and they can loan out the rest of it. This just keeps happening until all the money that has been created from this initial $900 loan, all that money has either been loaned out or held on to because it's required by law due to the reserve requirement ratio. So that's where the money multiplier comes into place. Again, the money multiplier is going to be 1 over the reserve requirement ratio. 1 over RRR. I swear that those are R's. Okay, and right now, that'll be 1 over our reserve requirement ratio at 10%. So it's 1 over 0.1. And that equals 10. 10 cents goes into a dollar 10 times. So our money multiplier right now is 10. So if I loan out, if Tay Bank loans out that initial $900 in loans, and all that money keeps ending back up in the bank and loaned out over and over again until every dollar is spoken for, well then we could have created up to 900 times 10, up to $9,000 just from this initial loan of $900. Let's try a little bit of practice now real quick.
We're in here talking about practice.
Okay, so we're going to do an example real quick. This is another version of Tay Bank. Here, first thing we always need to look at, 2 things. First, we look at demand deposits. What's in our checking accounts? Right now, we have $100,000 in demand deposits. And so our reserve requirement is the second thing we need to look at. So right now, our reserve requirement is 20%. So if the reserve requirement is 20% and we have $100,000 in demand deposits, well, 100,000 times 0.2 is going to be $20,000. This bank is required to hold on to $20,000 at all times. Right now in our reserves, we have $30,000. That means that we have $10,000 in excess reserves. There's $10,000 above the required reserves that this bank is holding on to. So for number 2, it says, or I guess it's not a number, but for the second problem, it says, what is the value of new loans that can be made by Tay Bank? Well, the excess reserves, the amount of money that a bank has that is above the required reserves, the amount that the Fed tells this bank that they have to hold on to, and all banks, anything above that required reserves, so anything above $20,000 is going to be available to be loaned out. So the excess reserves is the money that is allowed to be loaned out. So if our excess reserves are $10,000, well, the amount of new loans that can be made at Tay Bank is also $10,000. Next, we need to calculate the money multiplier. And remember, that's going to be 1 divided by the reserve requirement ratio. And so right now that would be 1 over 20%. So that's 1 over 0.2. 20 cents goes into $1 5 times. Our money multiplier is 5 at the moment. So what is the maximum increase in the money supply possible if Tay Bank wants to hold no excess reserves? So what that means is we're going to loan out every cent that we possibly can. And we're assuming that all this money just keeps getting put back into Tay Bank or a similar bank that wants to loan out every last time over and over again. Our multiplier is 5. Our initial loan is $10,000. So if we loan out $10,000 and our multiplier is 5, 10,000 times 5 is going to come out to $50,000 that can potentially be created by the banking system based on this initial loan at $10,000 and the fact that the reserve requirement ratio is 20%. We're going to work on more of these later on. I'll show you some more examples in another video. Goodbye.